Thank you all for joining today's 30-minute roundtable webinar presented by Dynamo Software and in partnership with Passthrough. As an attendee, you'll have immediate access to the collateral we have posted in the handouts area, including the recently released Frontline Insight Report focused on AI. This report includes findings from surveying nearly 100 general and limited partners. If you have any issues downloading materials, you can send an email to events@dynamosoftware.com. As you listen today, please feel free to submit the questions that you may have using the Q&A capability of GoToWebinar. Now let's get started. My name is Donna Parent, and I'm the Chief Marketing Officer at Dynamo Software, a leading high-growth, multi-tenant cloud software platform built specifically for the needs of the alternative investment sector, including private equity, hedge funds, real estate, venture capital, and limited partners. Dynamo is backed by Blackstone and Francisco Partners. I would like to take a moment to welcome you all again to this exciting virtual event, Revolutionizing Private Investments, the Next Wave of Workflow Automation. Today, we'll delve into how automation is reshaping private investments by streamlining operations, reducing manual tasks, and boosting productivity. We've really put together an esteemed panel today that will provide you with invaluable insights into the latest fintech trends and tools poised to transform your firm. Today, we're thrilled to have a trio of those industry experts here with us, and kicking things off, I'm very pleased to introduce Michael Sidgmore. Michael is the partner and co-founder of Broadhaven Ventures, a powerhouse in early-stage fintech investments. His work involves investing in fintech companies and incubating asset management businesses like GP stakes firm Cantilever Group and partnership with BTG Pactual. Michael is also the creative force behind the Alt Goes Main Street podcast and newsletter, featuring over 120 insightful conversations with industry leaders. Broadhaven Ventures is connected with Broadhaven Capital Partners, renowned for their impressive $90 billion in M&A transaction volume. Before launching Broadhaven, Michael was a pre-product employee and pivotal figure at iCapital, helping grow it into an operating system for private markets with over $200 billion in platform assets. His journey began at Goldman Sachs, and he has also played a key role at Mosaic, a pioneer in residential home solar financing. On top of his financial achievements, Michael is minority owner of Angel City FC, the women's soccer team in LA. Please join me in giving a warm welcome to Michael. Let's now welcome Tim Flannery, the co-founder and CEO of Passthrough, a pioneering company dedicated to streamlining the fund closing process for funds, administrators, lawyers, and investors. With over 3 years at the helm, Tim has driven Passthrough to the forefront of financial technology innovation, leveraging his extensive industry experience to simplify complex investment workflows. Prior to this, he was head of go-to-market for investor services at Carter, driving strategic growth. Tim spent his entire career in the private markets as a venture investor and at JP Morgan. His leadership and expertise in transforming financial workflows makes him a standout figure in the fintech arena. Welcome to Tim as well. Last but certainly not least, I'm also excited to welcome Matthew Arnold, or simply Matt, the General Counsel at Dynamo Software. Matt navigates the complex legal landscape across all our business units and is at the forefront of our innovative AI advancements. He's been instrumental in planning the swift development and deployment of AI and automation tools, ensuring we stay ahead with his deep understanding of legal, security, and regulatory challenges. Before Dynamo, he served as the general counsel at a prominent 10 billion asset management firm and advised leading asset managers and tech companies during his tenure at top law firms. Welcome to Matt, and again, welcome to Michael and Tim. As a side note, the opinions expressed in today's webinar are those of the speakers and panelists themselves and do not necessarily reflect the views of the organizations they currently work for, its management, or employees. All right, I'm going to get things kicked off here by handing things off to Matt. Matt?
Thanks, Donna. Hey, everyone. I'm very happy to be with you today. Let's dive right in. On the next slide, I'd like to talk to you about the challenge trifecta. So first, let's zoom out and do a little table setting. What are we really talking about today? What we're talking about is solving years worth, and in some cases, decades worth of operational challenges that virtually all firms face. Managing workflows manually, it's a time suck. It's resource intensive, it's imprecise, and it doesn't scale especially well. So we'll call that the challenge trifecta. But in a word, it's pain. It's painful. And here's the great news. It's all ripe for automation. And that underscores the need for innovation and adoption of automation and AI in this space. By embracing new technologies, firms can gain a real competitive advantage, not only by enhancing their operational efficiency, but also by unlocking new opportunities for growth and success. And on the next slide, we're going to talk about some recent research findings that we've seen. The trend is real and it's catching on fast. These are the recent research findings I mentioned, and these are from Dynamo's November 2024 Frontline Insight Report, where we surveyed nearly 100 GPs and LPs to understand their views on automation and AI in their investment workflows. And so if you look at the left side of the screen, you'll see a notable trend in the private investment community. 85% of LPs are either already using or planning to implement AI for automating data extraction and collection from GPs. That shift highlights a growing dependency on AI to boost operational efficiency and streamline data management. And by moving toward that automation, LPs can achieve more precise data handling, swifter insights, and enhanced decision-making capabilities. Now, if we look over to the right, we find that when LPs were asked about the area with the most potential impact of AI, document processing and automation came in second. That underscores this continuous push for greater operational efficiency. Automating these routine tasks not only cuts down on administrative burdens and costs, but it also increases accuracy. It allows staff to focus on higher value activities, streamlining operations, and aligning with the demand for enhanced transparency and compliance in financial documentation by refining document management processes. So overall, big picture, these insights reveal significant opportunities for LPs to leverage AI in transitioning their workflows and achieving strategic business advantages. And it shows that the market is already headed in that direction in a big way. This is really cool, exciting stuff. Now, speaking of really cool, exciting stuff, Tim, the CEO of Passthrough, is going to share some specifics around the transformative impact of automation in the private investment space. Tim?
All right, thanks, Matt. So the first thing we want to talk about is pretty much every fund manager wants to go grow their assets, but they want to go do it without adding a ton of expenses. And so on the next slide, we walk through exactly how they're trying to do that today. So if you want to go grow your AUM, and most of the ways that you do this in the past historically have been investing in more people, that is going to continue to grow your overhead a ton. And so how do you do it otherwise? You do it with technology and the automation that can bring. And so the first thing that people are actually working on is changing the purchasing process for their investors. Right now, you only have so many LPs and you only have so much AUM that they can go dedicate to your fund. And so people that are really trying to grow their AUM are looking to go open up new channels. It doesn't matter if that channel is high net worth, if it's in another geography, if you're moving into a different part of institutional capital. Every new LP adds hours of work just to onboard them, let alone service them. And so if you take a look at the example of what happened to discount online brokerages. This used to be something where people could only invest if they had a stockbroker, but then all of a sudden, when you created some software that allowed people to go buy and sell stocks on their own, well, then it made it really easy for everybody to participate in buying and selling stocks. And the point is, if that process is too hard, capital will go to where it's easy. Then you have simplifying the coordination challenges. When you're growing, your teams are going to grow. You're going to have more people that need to understand what they're talking about. You're going to have more partners, or you're going to have additional law firms or fund administrators, or you're going to have a lot more people to try to go bring together. And so when your finance team or tax team needs information for every capital call or distribution, or IR needs to go handle whatever the latest reporting request is, keeping track of what all the different tasks are is hard enough, let alone getting people to work on the same set of tasks. And so you actually need connectivity between these teams powered by software. And then you have the challenge of data. So you can't live in a world where you have one person in your finance team who has the entire scheme or update in their head when you've got multiple groups working together. You need a common language and common data scheme, and people need to be able to go get that information into their systems. And so LP requests are not getting simpler, they're getting more complex. And so you need to make sure that people are actually getting all of the data in one place so that you can meet those requests in any kind of a timely manner. Then you have this other challenge of, well, private markets are getting more and more regulatory scrutiny, and so staying compliant can become even more difficult. Alts have grown tremendously in the last couple of decades, and that doesn't look to stop anytime soon. And we've already seen movements from regulators to increase reporting on things like side letters for fee transparency. And we recently saw some regulators reclassify. We recently saw private equity and venture firms and real estate firms and credit firms be reclassified as financial institutions, which means they're now being regulated like banks when it comes to anti-money laundering or fraud. And so especially as more individuals get exposure to alts, there's just going to be even more focus on making sure people are staying compliant. So ultimately, if you want to go grow your AUM, if you can't automate your way out of this, then you just have a natural limit to how far you can grow. And so let's talk about a couple of examples for how people have done this. If you take a look at Sixth Street manages over $80 billion today. They've got nearly 30 funds in market, and that IR team has grown tremendously in the last decade or so. And so they were actually front and center with information hoarding. What they need to do is make sure that, okay, as we have more people, even though this is a culture where people can communicate freely and that culture is such an important backbone to it, it doesn't work when you need to go communicate across teams. And so they need to figure out how they were going to speak to each other. And so they set KPIs. And then they need to figure out, well, where can we actually go track those KPIs? So they launched a CRM. And then on top of that, they needed to figure out how could they go analyze what actions to go take on top of that. And so then they launched business intelligence tools on top of it. And then if you look at Lead Edge Capital manages about $4 billion. And they've been able to do that with a team that has grown from 2 to only 2. That's not a typo. That's actually correct. And so if they were going to try to raise their latest fund doubled in AUM and was going to be $1 billion fund, how do you do that with 2 people? Well, the only way you can do that is by making it easy for people to actually go through the investment process. And so you scale you need some scale to be able to go handle those 500 LPs across a $2 billion fund. And those LPs, by the way, are almost exclusively high net worth. And then you need some process to be able to make sure those LPs, the people that are coordinating on their behalf, the front office, the investor relations team, and legal would all be on the same page. And you only do that with software. Finally, we have a $3 billion venture firm. And this venture firm had a really nice exit, which is what everybody's looking for. But they need to return that capital back to their investors. The only way that they could do that, according to their banking partner, was to run a new KYC AML program on them. And so within 2 weeks, they needed to go out and they needed to run a process on 400 investors to go collect all the information about them and their beneficial owners and then make sure that they weren't sanctioned individuals or something like that. And the only way that you can do that is with software. You cannot hire enough people to do this in any way that will actually work. And so without automation, they would have been sunk. And so one of the things that we're tackling is automated investor onboarding. And so the first thing that we launched a number of years ago was subscription agreements and tax forms. We basically take the subscription agreement, we build a workflow that's totally configured to the underlying questionnaire, and then we can connect it to your other environments. So that means that the structured data that you already have inside of Dynamo, for instance, can be used to go speed up that onboarding process. And then when your investors actually go through, they just get one question at a time and the questions that are applicable to them. So they only need to focus on the 30 out of 150 questions that actually matter. And then finally, there's tools actually for the entire fund manager, their fund admin, their legal team, for everybody to stay on the same page. And then the other thing that we offer is SEC and FinCEN compliance. And so that means that we can actually be an AML compliance officer, sure, but the other way that you can go automate this is by making that collection of beneficial ownership information down to the 25% threshold in the US or 10% in other jurisdictions can work. And so we do this, a managed service offering in the US and Cayman today, with other jurisdictions coming soon. And then ultimately we can tie those into other systems, including real-time screening, risk assessment, and monitoring. We're doing this for over 600 clients today. We've got over 50,000 investors that can reuse their information across any investment on pass-through and in pretty much any jurisdiction that you can think of. And so this makes that buy process easier, and then connects into your other systems like Dynamo so that you can make sure that that post-trade process runs just as smoothly.
Excellent. Thanks, Tim. And thank you too to Matt. All right, we're ready to get right into our panel discussion now. So let's get to our first question. Question number 1, which is around automation with private investments. How have you seen automation transform the private investment sector in recent years, and what do you predict for the future? Michael, would you please kick us off?
Yeah, thanks, Donna. I think really important question to understand, and also first, I think, zoom out. So if we think about what's happening here, there's both a distribution evolution. So more investors are now accessing private markets. The wealth channel is in size and scale similarly large to the institutional channel, yet the wealth channel investors are underallocated. I think part of this transformation, this automation around transformation and kind of evolution in technology infrastructure is really due to the fact that this is not just a nice to have for the industry, this is a need to have. If many of these managers, Tim mentioned one of them, Sixth Street is a great example, massive firm, as they scale and work with the wealth channel, they're going to need to use automation. So I think it's important to zoom out. And if you think about this in the context of market structure evolutions, we saw equities, as Tim mentioned, go through that, right, with brokerage firms now enabling kind of click to buy almost. We're not there yet in alts, but I think at some point that will become a place where this heads. But you think about equities, fixed income derivatives from pre to post investment or pre to post trade, it went through that market structure evolution from a technology perspective. So as this distribution evolution is happening, this technology market structure evolution is enabling that to happen, and for all these large firms to work with the wealth channel. So I think this is only the beginning, because we're only just starting to see the wealth channel get involved in private markets. But this is, I mean, this is one of the core aspects of private markets becoming more mainstream, because for a lot of wealth managers, I talk to a lot of them in various shapes and forms, podcast, otherwise, if the process isn't easy for them, that may preclude investors from investing.
Excellent. Thank you, Michael. All right, Tim, over to you for your opinion.
So I think there's a couple things. One is that we're moving away from things that happen on paper and need to take a bunch of times to things that happen on demand. And so things like subscriptions, redemptions, even going out and updating wire instructions, those workflows are being exposed to LPs to make it simpler for them to do whatever they need to actually make life easier with their fund. Then you probably have use case specific workflows. So before, if you wanted to go generate a capital call notice as a GP, you would have to go do mail merge. And then obviously software has gone out and improved that, so you can click a button and send 1,000 investors a capital call notice in about 20 minutes with a very low chance of error. And so those kinds of things are just only going to continue to happen in more and more use cases. And then there's integrations itself. So fund managers today live in multiple pieces of software, and they need those things all to connect. And the only way that they're actually going to be able to connect is by using APIs. And so these use case specific workflows probably don't sit even in just one system. They probably sit across systems, and it's important that those things talk to each other.
All right, let's go over to Matt now for his view.
Yeah, I think that's all spot on, what Michael and Tim said. I'll add, just from a market perspective, I think the sector is on a fast track toward this increased automation. And I think in the coming years, we should expect to see deeper integration of automated technologies, from AI to blockchain, low-code platforms, These are all going to drive even greater efficiencies, personalization, and transparency. And obviously, the upside is clear. You're going to see a reduction in operational costs and risks, but you're also going to see new opportunities for firms to innovate and offer more value to their investors, like Tim and Michael were talking about. And you'll hear me say this a bunch, during this session. I think there is some urgency here. I think firms that embrace these technologies early will gain a competitive edge, while those that lag may find it more difficult to keep up with this rapidly evolving market and the regulatory demands incumbent upon it.
Thanks, Matt, and thanks to our panel. All right, let's keep moving here because I do want to get into common challenges next. What are the common challenges firms face when implementing automated workflows, and how can they overcome these hurdles effectively? Matt, let's kick it back to you again.
Well, with any new technology, there are always implementation challenges. Implementing automated workflows is no different in that respect. And some of the most common challenges are going to be change management resistance, process complexity and fragmentation, integration issues, quality of data. Automation really relies heavily on data accuracy, so quality control is going to be key. I think monitoring and maintenance are going to be important, and security and compliance. And I want to double click on that last one because that's somewhere where my team at Dynamo has spent an awful lot of time. Automated workflows need to comply with applicable regulations. So GDPR and CCPA are good examples when handling sensitive information. The good news is that's very doable from a process perspective, but I would encourage firms to integrate their legal and compliance teams early in the process. It's also clear that automated workflows can create new attack surfaces or vulnerabilities if they're not properly secured. So let's address that head on. You want to work with companies that you trust, companies like Dynamo and companies like it that have taken critical steps to ensure that client data stays on an island, doesn't cross-pollinate with the large language models, isn't stored or saved or audited or used to train the AI models. And I'd encourage firms to take similar steps and work with their trusted vendors to get this right, but don't shy away from these technologies given the remarkable upside that they offer.
Michael, let's have you weigh in.
Yeah, so I think I'll touch on two aspects of this. One will be from an investor perspective. We've invested in 21 companies in private markets infrastructure from pre to post investment at Broadhaven Ventures. I think one thing that both the buyers of the technology, so either GPs or LPs, as well as the creators of companies, which Tim at Pass-Through is one of them, is, early on, many times these companies are selling to larger buyers, institutional asset managers, the Blackstones, the Apollos, et cetera. It's important to understand that you need to build for scale right away, because I think a lot of these larger clients will ask, can you work with us? Their technology might be great, but can you actually work with us and all the requirements we need around things like security, data privacy, et cetera? Same goes for large wealth platforms, private banks, et cetera. So I think that's one thing that is maybe a bit unique to this space, is that many of the large firms in this space on the GP side need this technology. They are growing their tech budgets. If they haven't already, some of the largest firms have very large tech budgets, and others will look to add to their tech budgets as they grow their LP base and diversify perhaps into the wealth channel. So I think that's one thing that's really important. I think that then gets into the type of founder that's a great fit to build one of these types of businesses, which is someone who understands the industry dynamics and understands the different pieces and nuances that come into play when you're trying to build something like this. So that's one piece. The second thing I'll say is that I think specific to the wealth channel, one of the challenges is there's so many different types of investors to deal with. There are family offices, there are large wealth platforms, there are private banks, there are independent wealth managers, there are different client types, there's larger investors, there's accredited investors, there's non-accredited investors, although they're not really investing in alts for the most part. But as we get into evergreen structures, et cetera, I think we'll head towards that direction of travel. So I think that's the other piece of this, is there's so many different use cases that need to be solved for in the wealth channel that can make this a challenge. And I think people are building for it, but that's another piece of this that's so important when it comes to how do you build the right kind of software for the right type of end customer. And I think if both the technology companies as well as the GPs think about the end customer, who is the client, that's going to be how they build the right product for them.
Excellent. Thanks, Michael. All right, Tim, over to you.
I think one of the things firms run into is when they're trying to build something. Perfect is the enemy of the good. They try to make implementations too complicated because they're overfitting for edge cases. If you try to automate 100% of a process, that's really hard because it's actually that last 1% of edge cases where you can run into trouble and double the complexity to the system you're running. And every time you add complexity to the system, that means that you're reducing usability for everybody else that's involved, whether it's your internal teams, your investors, doesn't matter. And so instead of focusing on how to make a workflow that solves 100% of things that could ever happen, just figure out when manual intervention is actually required. And so if there's a really complex problem, maybe it shouldn't be solved by that integration. Maybe it should be solved in Excel or with a phone call to your investor instead.
Thanks, Tim. Okay, let's keep moving forward here. I want to move on to now investor onboarding. How does automated investor onboarding enhance accuracy and efficiency compared to traditional methods? Tim, will you pick this back up, please?
Yeah, so on the subscription document side of the world, our experience with subscription documents before software like Passthrough came along was that it would take about somewhere between days and weeks for somebody to go return a subscription document, and only about 20% of the time would they be marked in good order. That means the law firm looks at it, or the fund administrator looks at it, says everything here is good to go, it's accurate and complete, and they're ready to move on. And so what happens is they have to go back to everybody and say, well, let's go out and change section 4C3 to 4C2, and then it still requires multiple terms after that. And so the way that automated subdocs can actually make it easier is, well, first you can do one question at a time. And so when it's one question at a time, it's actually proven to increase comprehension on behalf of the investor. So even if it's somebody who's never seen a subscription document before, there's just enough information for them to be able to go answer instead of feeling overwhelmed. And then there's actually just asking the questions that are relevant. So there's about 150 questions on average in a subscription document. You should really only see the 30 that apply to you. The other 120 have nothing to do with what you're doing. Why are you spending time on it? And this should also be something that follows people where they need to go. It actually should work on your phone. You shouldn't have to go deal with, how do I go print something out or save it down and then go configure a signature somewhere else and then go scan it back. It should literally just work on your phone, even if you're hanging out on a beach somewhere with very limited internet access. But you can't forget people on the back end too. And so your lawyers, your fund administrators, if the process doesn't work for them, then it's going to break down. One of the challenges with all of this is there's multiple parties. And so if those parties aren't considered first-class citizens in the systems that you're using, then yeah, the whole thing is going to break down. But you also want to make sure people aren't just staring at a set of emails and wondering if it's the most recent thread or which one are people actually responding to. You need a single source of truth, and people need to be able to go access that all the time. On the KYC AML side, the place where people run into all sorts of problems here is when I'm an individual, it's really straightforward. It doesn't matter what jurisdiction I'm in. Here's my passport and proof of address and maybe another piece or two of information. But if I am a trust or I'm an LLC, those trusts or LLCs have additional owners underneath them, which might be trusts or LLCs or corporations or anything else underneath. And so typically what happens is somebody sends out a list and then the LP comes back with a zip file that hopefully they haven't shared over email and has been shared over a secure online system. And you find out there's only about 70% of the documents you need because everybody's just been trying to manually check boxes on a list. And turns out that doesn't work. And so you have to just keep iterating through until you finally get all that. And then on the back end, the team actually doing the review needs to make sure they do have a process to track all those different revisions. And then they need to take that information, copy it into another system to then see whether or not any of those individuals are on a sanctions list somewhere, or they're politically exposed, or they've had some issues with fitness and probity, or they might have some adverse media. And so instead of running that across multiple systems, what investor onboarding can do is make it really simple for investors to know what information they need to provide up front, and then have tools on the back end to verify the data that is being used to automatically screen, not just upfront when you're assessing risk initially, but then on an ongoing basis too. Because the standard of, well, I'm just going to go check out what's happening with my investors at this point in time when they're admitted to the fund, that doesn't work anymore in the United States. Now you need to have nightly screening, and it's not even just something that's on your investors in your latest fund. That actually has to apply to every investor that's ever been in a fund that's active and not liquidated, associated with your ERA or RIA registration. So That is a massive change that's coming to investors that they're going to have to figure out how to solve by January 1st, 2026, because that's when the SEC and FinCEN are going to start auditing and making sure that, yeah, you actually do have your house in order when it comes to anti-money laundering.
Thanks, Tim. Matt, let's have you weigh in now.
I think Tim absolutely nailed it. I mean, by eliminating manual errors, by speeding up onboarding and democratizing access to onboarding, and by integrating compliance workflows, I mean, he's describing a really tight, streamlined approach, and that's going to enhance the investor experience. It's going to ensure regulatory compliance, and overall, it's going to provide firms with much better operational control. And I think as those tools that we're talking about continue to evolve, firms that adopt these solutions, again, are going to gain a real competitive advantage over their peers, because it's all reduces significant friction in the investment process across the board, from a user perspective and from a regulatory perspective, from a front office perspective, from a back office perspective. And what that translates to is significantly improved scalability at the end of the day.
Thanks, Matt. All right, let's close this out with Michael's view.
Yeah, I'll just share more of a user perspective of business, like pass-through as an example. So we've invested in a number of funds. We've invested in over 20 funds as an LP as well. And obviously, we've gone through the process of signing subdocs. It takes time. It's easy to have errors. People make human errors, or it takes time to fill out, things like that. We ended up actually getting to know pass-through because one of the funds we invested in uses pass-through to do their subdocs, and it took like 6 minutes to do a subdoc. So that's just kind of a real-world example of how much automation can make a difference. And I think what's really cool about that example too is not only is it great for the LP because it saves a ton of time and takes a lot of complexity out of the equation, it's also great for the firm because they then can kind of be more efficient and streamlined in the investor relations function. But it also, I think, puts the fund or the firm in a really positive light to the LP because we just had a great experience. And I think that really matters. Point of sale, if you can have a great experience for the end client, the LP, particularly as newer investors come into private markets, that's going to make a big difference in their desire to actually want to come back.
Love it. Thanks, Michael. All right, let's keep moving on here because we touched on compliance, but we're going to drill into this a little bit more now. In what ways can automation help reduce errors and improve compliance in private markets? Tim, I'm going to hand this over to you.
Well, the most common error is a person that's taking a piece of data in one place and moving it to the wrong place, or moving having a fat finger on a number or something like that. And so if somebody was going to go fill out 100 capital call notices by hand instead of uploading a spreadsheet and pressing a button, yeah, you're going to run into a good amount of errors. If a human makes a mistake 1% of the time they do something, well, then the way to mitigate that isn't to reduce that to 0.5%. It's to just reduce the number of things that people have to go do. And compliance is basically making sure that you're checking a bunch of things off on a list. And so the big problem is actually keeping the checklist up to date. Automation makes it really easy because you have one place and you have one piece of software that makes sure that you're doing everything that you need to do according to a set of rules that continue to change and evolve around you. And so I'd already mentioned the SEC FinCEN ruling from August of 2024. Yeah, the world has changed dramatically for private funds today. And so the only way that they're going to be able to, first of all, get up to speed on it is by having software that they know is compliant with all of those rules. But those rules are only going to get more complex. And so the question is, do you want to have an internal competency where you need to go build all of that stuff out? Or do you want to have a piece of software that just takes care of it for you so that you can focus on the things that generate real returns for your investors? And it's a real question. It's a question on whether or not people think that that is really critical for their business to go own versus something that they really just need to go solve. And everybody needs to go make those trade-offs. For some firms, it is important for them to go have that internally, but for other firms, it's just nice to have a partner that can make sure that they're staying in line and they're doing what they need to do, so that when that surprise audit happens, then they're passing.
Matt, what do you have to say?
I mean, look, automation can significantly enhance accuracy, full stop, and it can ensure compliance in private investments by streamlining these very complex processes and reducing human intervention. I mean, Tim's absolutely right. Reduction of human error is key. So I'll just focus briefly on standardizing compliance processes as well. With this kind of automation, firms can also ensure timely and accurate submission of regulatory reports without manual effort. They can create audit trails for regulatory oversight for their own internal audits. They can set up alerts when compliance deadlines are approaching or when specific thresholds are breached. All of these things together and the reduction of human error are going to be huge unlocks for firms moving forward to help reduce errors and improve compliance across the board.
All right, let's keep moving. Thanks for that, Matt. All right, as we move to our next question here, how do you balance the need for automation with maintaining personal relationships and client interactions in the investment space? Matt, can you pick this one back up?
Yeah, I really like this question, and I'm glad you asked it. I'd recommend a hybrid approach. I think that balancing automation with personal relationships in this space is critical, especially when you're dealing with high net worth individuals, institutional investors, and complex investments. And that can be tricky, but I think the key to successfully creating that balance is to let automation handle routine processes. And that frees up people, relationship managers, with time and tools to focus on having meaningful client interactions. I think by strategically blending automation with the personal touch points that our clients expect, firms can scale operations much more efficiently while also maintaining strong client trust and loyalty. A hybrid approach not only is going to enhance operational performance, but it's also going to ensure that long-term human relationships are able to thrive.
Michael, let's hear what you have to say.
Yeah, I think great question, because this is going to be something going forward as there's more automation and workflow within private markets. The question becomes how do personal relationships and client interactions stay at the forefront, both for large asset managers with clients and LPs or intermediaries like advisors, and also advisors within clients. And I think the answer is it's going to be an enabler. So it's going to enable the advisors to do more with their clients and spend more time with them on the things that matter rather than the operational overhead and challenges with some of the workflow processes. So I think from that perspective, really important evolution in the technology innovation here that'll make things easier. I think the other aspect of this is that it's kind of a business imperative for the GPs, the alternative asset managers. I mean, if you think about these firms as businesses, some are now public, more are going public. And when you think about the way people will look at those businesses, investors in public markets, they're going to say, okay, how efficient are these businesses? Where's their margins? What are their margins like? Alternative asset management businesses are amazing businesses because they can, to some extent, really continue to scale AUM without having to scale the people and operations too much. I think the wealth channel puts pressure or strain on that potentially because you do need more people from an operational overhead perspective in certain cases on either distribution or operational sides, particularly as you get into innovations like evergreen structures, so more kind of perpetual or evergreen vehicles where there's no closed end fund structure in that model. And I think this is all part of that too, where this actually enables these large firms to balance both innovation in automation, but also have relationships and have the right amount of people to deal with those relationships in the wealth channel with either intermediary, so advisor, or end client wealth channel investor.
All right, Tim, over to you.
Yeah, I agree with everything that Matt and Michael both said. The place where people can get into a little bit of trouble is when they try to take a look at using automation to build the relationships itself. And so something that's faux personalization where, I don't know, you have something like an LLM just going out and writing an email for you and sending, that's going to be destructive, because what people are going to notice really quickly is, yeah, that's not personalized. That's just software. But it doesn't mean that you can't automate the kinds of signals that you want there. And so you can monitor your in-house data or third-party data, and you can see if somebody's in the news or published new research or whatever it is. You can take a look at how LPs are engaging with your content if you're a GP. or they aren't engaging, to figure out the right time to go engage with someone. And so the place where automation helps isn't necessarily with the messaging you want to put out, but in pulling together the kinds of signals that you want so that you can actually get that message out when the time is right.
All right, thank you for that. All right, let's move on to some advice now. What advice would you give to investment firms hesitant to adopt new technologies and automation tools? Tim, back over to you.
So I would ask them to think about the last time they went to their mechanic. So the last time you went to your mechanic, you had some squeaky brakes, you took the car in, you got it checked out. Mechanic goes in and fixes the brakes and everything seems fine. But when you go to pick the car up, you notice that they still left a bunch of papers in there and some trash, and there's a little bit of oil that's spilled on the passenger seat. It doesn't matter how well they actually fixed the brakes. The thing that you're going to go take away from that is, I've got an oil stain on my seat. And so your investors, they're investing with other managers, and technology is a core part of the way those investors experience your firm. And so if your competitors are investing in technology and automation and you're not, you're going to look like you got some oil on your seat.
Michael, what do you think?
I think I touched on this a bit in the last answer around the evolution of these alternative asset managers as businesses. I think it's going to be part of the business imperative, and I don't think that necessarily is much different in terms of the thought process whether you're a large manager or a smaller manager. Smaller managers, I think Lead Edge was a great example that Tim gave. They have 2 people and they scaled their IR team to 2 people. So didn't scale it at all and still managed to grow AUM. And that's great from operational efficiency perspective. So I think it proves that it can be done. Now, also firms that do scale and want to add people to the mix, and I think there are places where it absolutely makes sense to add people to the mix, they're going to need to find ways to scale their operations, particularly post-investment. I think the post-investment experience, both for them internally in terms of dealing with the processes of onboarding investors, tracking and managing those investors, managing the valuations, portfolio monitoring, and accounting, all of those post-investment things are going to be critical to continued success for these firms from an operational perspective and efficiency perspective. So I think that they're going to really look to grow and scale those functions leveraging technology. Then I think we're going to get to a place where pre-investment becomes really important because it's going to come down to the investor experience. And I think both of those areas are places where a lot of these firms can really think about where can they leverage technology to do that well. And that I think is the case whether you're a smaller firm and want to stay small but use technology to be a force extender, or a large firm that wants to continue to grow and is cognizant of their margins.
Matt, over to you.
Yeah, 100%. It's worth viewing this as an opportunity, not as a threat. These technologies are going to be huge unlocks for the entire space. And as we've already talked about, automation doesn't replace the human touch. It enhances operational efficiency, and it frees teams up to focus more on strategy, client relationships, and innovation. And I think Michael's absolutely right. There is a competitive risk of inaction in this space. Market expectations are fundamentally shifting, and investors increasingly expect faster service, personalized communications, and transparency. And those needs are going to be difficult, if not impossible, to meet without automation. And again, I'll say it again, your competitors are adopting automation. So delaying adoption can leave your firm behind as others benefit from improved efficiency, reduced costs, and overall better client experiences.
All right, thank you. Let's move to our final question for the session today for our panel, focused on trends and innovation. Could you discuss any upcoming trends or innovations in fintech that you believe will further revolutionize private investments? All right, Michael, let's hear what you have to say.
Yeah, look, I think Matt alluded to it earlier. I think this is a space that is moving at the speed of light. Not surprising because of the opportunity in private markets, both for the asset management side of the business, as well as investors who want to invest into private markets and new investors coming in. But I think we're at the point where it feels like things have really reached their fever pitch, and they're only going to go in one direction, which is continued acceleration around innovation and technology. I'm really interested in the post-investment technology part of the value chain. I think if you can solve problems like data aggregation, portfolio monitoring, valuation software, investor onboarding, these are areas where if you make those processes easier, it's going to make it easier for more capital to flow into the space. I think so much of what's been an impediment to investing in private markets, particularly for the wealth channel, which, Bain, I think, has it at about 150 trillion of collective wealth channel AUM globally, but yet 2 to 3% of that is allocated amongst the wealth channel into private markets. Contrast that with the institutional channel, which is kind of 20, 30+% allocated to private markets. You need to find ways to make it easy for the wealth channel to invest in private markets. And I think a lot of the technology that's being built post-investment is making that possible for the pipes to be built to make it easier for people to invest, and then more capital will flow into the space. If we want to talk about, Preqin's prediction of 30 trillion by 2030 in private markets, so roughly a doubling of overall aggregate AUM in the space, I think you have to have these post-investment processes in place, and that's going to come from technology innovation. So I think a lot of work there will help the space continue to grow, investors invest in this space with ease, and then that'll circle around to the pre-investment side, where I think that's going to be another big area where how do you make it easier for both investors as well as funds to navigate the pre-investment processes and build relationships in the right way. I think access was table stakes. We're kind of beyond that now with platforms like iCapital or Case, Moonfair in Europe as some examples. But then I think we're going to get to the next phase of this, where it's really about how do you make this as easy as possible for people to allocate.
Tim, what do you think?
So I think there's a ton of work to be done on the process being made easier and the data being structured so that you can actually do this drive to retail, which is the most likely place where you're going to have massive AUM expansion in privates. The other thing that could pop up for this is it's not just automation in this, it's actually a change in products. And so the approach, especially for retail in the last 10+ years, has been that they should just go into feeders. And that might continue to be the case, but it's possible that investor preferences don't line up with that. There was one very large asset manager that set up a REIT, and that REIT had redemption rights, and it was offered to a number of retail channels, and there were more investor redemptions than anybody suspected, to the point where they had to go freeze redemptions. It might be that liquidity is something that needs to be baked into an asset class that has historically been very, very illiquid. And so it doesn't, who knows? Does it need to be liquid? Does it need to be redeemable? Does it need to be tradable? And so I think there's just a big unknown about, are there going to be new products introduced to this? And then from that, if there is a product that everybody kind of agrees upon, then what do you go do? How do you go automate all the pieces of it? And so every ounce of automation that Michael's talking about is important. It's critical today for the alts world, because for it to continue to grow, it needs it. But there might even be another layer that happens because, well, we might just have a brand new product, and that new product is a new set of rules that you need to go figure out.
Matt, let's hear from you now.
Yeah, I think we'll continue to see big advances in AI and automation, no doubt about that. And I think we'll not only see automation of routine portfolio management and other streamlined processes, but I think it's really interesting to think about increases in personalized investment strategies based on market trends and individual client goals. They're going to be unlocked because of these advances. AI is making wealth management services a lot more accessible, a lot more scalable, while enabling firms to focus more on customized relationship management with clients. I also think we're going to see a lot more activity with embedded finance, things like smart contracts, open banking, data sharing, and I especially think we're going to see huge advances in the cybersecurity space. And I think it's really exciting. I think this all suggests a continued push toward a more efficient, secure, and frankly personalized investment process. It's going to be a really exciting ride. Back to you, Donna.
Excellent. Thanks so much. And first of all, thanks again to our esteemed panel comprised from experts from Dynamo, Pass-Through, and Broadhaven Ventures, Matt, Tim, and Michael. We appreciate your time and sharing of your insights today. As a reminder, today's session was recorded and you will have access to the on-demand playback along with the additional important resources that we do have up in the handouts area. You'll receive all of these within the next 24 hours. Again, we would like to thank everyone for joining today's virtual event. And as you exit today's session, there is a short survey that will appear, and we would really appreciate any and all feedback you'd be willing to provide us with. Thanks again for your interest in Dynamo's Alternative Investments webinar series. Have a great day.